When capital enters your accounts without a predefined routing system, it scatters. Gross income breaks apart into dozens of chaotic, unmanaged microtransactions. A daily $5 coffee, a $15 lunch, and $4 transit fees, combined with roughly $140 in monthly subscriptions, function as constant leaks straining your baseline liquidity. These specific recurring outlays aggregate to over $10,000 in lost capital every single year. Wealth accumulation is the mechanical output of a deterministic routing algorithm. By engineering a strict 5-step capital allocation protocol, you can automatically categorize, protect, and multiply your incoming cash flow. Operating without a rigid system guarantees the erosion of your wealth. Only strict, automated pre-allocation forces capital preservation. The initial audit phase requires raw data. Extract 6 months of your recent banking statements to isolate every recurring expenditure. Apply a strict binary categorization protocol to this data. A need is a utility required for basic survival, like rent and insurance. A want is any discretionary lifestyle enhancement. Here is the core constraint. The total cost of your needs, your financial baseline, must be systematically engineered down to exactly 25% of your total income. To see exactly how this limits your outflow, look at this geometric breakdown of your total income. The system limits needs to 25% and wants to 25%, leaving the rest unallocated for growth. Hitting that target often requires structural changes, like downsizing housing or eliminating vehicle expenses. If cost reduction hits a floor and you still exceed 25%, you must pursue a higher primary income stream to correct the ratio. Restricting your baseline to a quarter of your gross pay is the absolute foundation. It unlocks the liquidity necessary to execute the rest of the wealth protocol. Step 2 of the protocol diverts the first block of that newly freed excess capital to secure immediate liquidity. This schematic outlines the precise routing instruction. Route exactly 20% of your gross paycheck into a high-yield savings account. It must capture a high yield, but the capital cannot be locked in time-gated bonds. The target volume for this vault is exact. It must hold enough liquid capital to cover 3 to 6 months of the precise financial baseline you calculated in Step 1. To protect this pool, house it at an entirely separate banking institution. This introduces deliberate friction against spending it on a discretionary whim. This pool is an active defensive shield, not a growth vehicle. Its sole function is to prevent reliance on high-interest credit during a systemic life shock. Step 3 deploys 30% of your capital stream to capture a mathematically guaranteed return by eliminating high-interest liabilities. When targeting debt, there are 2 dominant models, the psychological snowball method and the mathematical avalanche method. This visualization compares the 2 structures directly. The left side tracks the snowball method, where you pay the smallest principal first to generate emotional wins. The line descends slowly, incurring interest penalties over time. Now look at the right side. The avalanche method strictly targets the liability with the highest interest rate first. By prioritizing the highest rates, the avalanche method clears the exact same debt load 2 months faster, saving over $1,000 in interest. Optimizing a personal balance sheet requires discarding emotional comfort. You must execute your capital deployment based on mathematical efficiency. With your safety net built and high-interest debt cleared, Step 4 routes 35 to 40% of your capital into long-term compounding engines. When you invest in standard accounts, capital gains tax creates a structural drag on your long-term wealth accumulation. You solve this by legally shielding your returns using tax-advantaged accounts, specifically a Roth IRA in the US or a stocks and shares ISA in the UK. Within those shielded accounts, deploy capital into broad market index funds. Utilize accumulation funds to automate reinvestment. This graph plots the mathematical output of that exact setup. By inputting just $250 a month, the curve steadily compounds over 45 years. Assuming an 8% historical average return, this automated input results in a peak portfolio value of $1.3 million, shielded from taxes. This compounding phase relies on automation to remove human interference. It ensures your capital scales independently of your active labor. Step 5 deploys the final 5 to 10% of your initial income stream into high-variance risk capital. This final stream routes strictly into venture projects or digital assets. By keeping your side hustle or venture capital constrained to this small percentage, you force operational creativity and protect the main portfolio. If you route this into highly volatile digital assets like cryptocurrency, you must acknowledge the risk. These assets have the potential to go to zero. Therefore, frame these allocations strictly as isolated, calculated risk plays designed to test high-reward environments. Exposing your capital to high-variance assets is only mathematically viable because the preceding 4 layers of this protocol protect the system's core stability. Look at the fully operational protocol. You lock the baseline to 25%, secure 20% for liquidity, amortize debt at 30%, compound 35% tax-free, and risk the final 5%. This specific 5-step schematic automates the routing process, reducing the frequency of discretionary decisions that lead to capital leakage. Setting this exact algorithm on autopilot transitions your economic status. You stop relying on manual labor and start operating a capital scaling machine. Reaching financial independence is the result of rigorously routing the capital